Hello, everyone. Welcome. Thanks for joining us today. So I'm Andrew Grant. I head up thematic research at Carbon Tracker. It's my great pleasure to moderate this session on emissions targets in the oil and gas industry. So for those of you that don't know Carbon Tracker, we're an independent think tank. We look at issues in terms of energy and climate change. We're particularly trying to understand what the limits on fossil fuel use will mean in financial terms, primarily for financial audiences. So this webinar is part of London Climate Action Week, which runs from the 26th of June through to the 4th of July. London Climate Action Week is the annual event bringing together world-leading climate professionals and communities across London and beyond to find practical solutions to climate change. And that's the largest independent climate change event in Europe. You can find out plenty more at londonclimateactionweek.org. So today we'll have a presentation from my colleague Mike Coffin, who's a senior analyst in the oil and gas team at Carbon Tracker, in which he'll discuss our recent report on what's now a hot topic in the energy industry. That's the emissions ambitions that oil and gas companies set themselves, how fit they are for purpose, and what they tell us about company preparedness for the transition. This will then be followed by discussion by our fantastic panelists, and then hopefully we'll have plenty of time after that for an audience Q&A. So we have 1 hour. I'll keep it brief to leave plenty of time for that discussion with the audience afterwards. The way to enter questions is through the chat box at the bottom, I think. So do feel free to do this throughout. Great. Well, over to you, Mike.
Great. Thank you very much, Andrew. And hello, everybody. So good morning, everybody. So today I'd like to do a brief overview presentation of our most recent report, Absolute Impact 2021, Why Oil and Gas Net Zero Ambitions Are Not Enough. Now, this is a follow-up report from the first report, Absolute Impact, we released last year in June 2020. And really what we'd like to do, what I'd like to do is give a real overview of some of the very high-level climate science and the kind of concepts of the carbon budget, and then how it's critical that company targets, both for the planet and to protect investors' interests, link through to finite climate limits. I'll then discuss conceptually some of the key points there before moving to a relative ranking of some of the largest oil and gas companies in terms of their positioning on climate, and as Andrew says there, then how this translates through into their overall positioning on the energy transition and the pace at which companies see that happening. So here's the report, and the kind of this. If you take away one key thing from today, is that absolute emissions reductions are critical to meeting Paris goals. So ultimately, to stay within the carbon budget, the pathway to net zero is crucial. Getting to net zero is critical, but the way we get to net zero and the pace of emissions reductions is what determines the warming outcome for the planet. So if we want to stay within 1.5 degrees by 2100, it's not about just getting to net zero, it's how we get there that's crucial. And both for the planet and for investors, the way emissions targets or ambitions are framed is critical. Ultimately, for us to meet Paris goals, oil and gas demand will need to fall, and this will become increasingly inevitable through the energy transition, and this creates stranded asset risk. To link to planetary limits, we see that climate goals must be framed appropriately, and the Carbon Tracker defines 3 hallmarks of Paris compliance, which we see as being critical to create this link. And we'll go through those in more detail through the presentation. We think it's important that investors can also use climate goals as a proxy for the company strategy and the company viewpoint on the pace of transition. And when we review those companies within our relative ranking, we look at 10 of the largest listed oil and gas companies globally. And we see a clear 3-tier approach there. There's an Atlantic divide, but also within Europe, we see very differing strategies too. So sort of those are the key takeaways that I'd like to leave you with from today. And now we'll sort of expand upon each of those points in turn. So what I've got here is a slide just really going through why the pathway to net zero matters. So we just said getting to net zero is not in itself sufficient to reach climate goals. For any given temperature outcome, there's a carbon budget. So for example, if we want to stay within 1.75 degrees, so the well below 2 degree goals of the Paris Agreement, there's a 920 gigaton of CO2 is the budget. And for context, we currently emit around 41.5 gigatons of CO2 globally every year. So you can see there's less than 2 decades at current emissions to stay within that budget, even if emissions were to remain flat and then cease immediately. It's the level of aggregate emissions versus that carbon budget which determines the warming outcome. So it's not just getting to net zero, it's how we get there. Ultimately, it's the area under the curve. And so the pace of emissions reductions is crucial. So if we move now to the right on the slide, what I've done is I've got some drawn some schematic diagrams for that 1.75 degree carbon budget, 920 gigatons. So on the top chart, what you're looking at is the net annual emissions. So if you're around 40 gigatons a year, if we have a slow emissions reduction, that red path, and we reach net zero in 2050, the area under the curve is greater than the 920 gigatons, which is what's shown on the red path on the bottom. And so we break that carbon budget in 2035, well ahead of 2050. You then have this period of net negative emissions post 2050, to where under that scenario, and some climate scenarios have this net negative emissions period, where that negative emissions period is ultimately it's a scenario where people try and give a space to continue production in the short term, and it'll all be fine because after 2050 we'll have net negative emissions to bring it back. But of course, it's a very risky strategy. Who's going to pay for this? Is this the oil and gas companies? Is it global society in general? Who pays? We see that as a very risky strategy, even assuming that there are no feedback loops within the climate system and that we can exceed a budget and then have net negative emissions to keep temperature at this level. In contrast, if you look at the fast pathway, so the fast emissions reduction pathway in the green, where you start from that same 40 gigatons a year right now, if you reduce emissions at a faster pace, still reaching net zero in 2050, the area under that curve is less than, or is exactly 920 gigatons. So you don't ever break that carbon budget. And we see that as, that from a climate science perspective, is a much less risky way of sort of staying within that carbon budget and reaching that 2100 limit. Of course, if you keep going flat emissions, or emissions rise in the short term, you'll get an even greater temperature rise by the end of the century. So the key thing here is the pathway towards net zero matters. It's not just that net zero point of reaching net zero. So to reach those global climate goals and for emissions to fall, fossil fuel usage must fall. And we see in the well below 2 degree scenarios from the International Energy Agency, well below 2 degree scenarios, which is the goals of the Paris Agreement, we historically have used the beyond 2 degree scenario and the sustainable development scenario, which are around 1.6, 1.65 degrees C. What the chart on the right shows is that the red line is the stated policy scenario, so that's the sort of a business as usual scenario, and you see oil demand sort of gradually rising over the next 2 decades. What you see in the grey and the dark grey bars, area on that chart is existing supply from producing or already sanctioned oil and gas fields. And the reality is there's very little space for new oil and gas supply on that. And we've heard very, very recently that there's no new oil and gas under the IEA net zero 2050 scenario. So depending on which scenario you choose and what temperature outcome you're looking for, there's still very little space for new oil and gas. What's crucial here is if there's an oil and gas company, you plan on that business as usual, so that red pathway, that stated policy scenario, that's a 2.7 degree warming outcome. So if you plan on that, yet the world does progress, as we all hope it does, towards meeting Paris goals, and whether that's policy action or increased in societal awareness, or ultimately out competition from renewables, if you follow that sustainable development scenario, but as a business you have been sanctioning, assuming business as usual world, you risk creating stranded assets. So projects that are just not needed in a low carbon world. So ultimately, oil and gas companies are exposed to falling demand in oil and gas, and they need a value focus to reduce their transition risks. So the role of targets. Targets must protect the planet and investors. And to meet climate goals, and just to reiterate this point yet again, absolute emissions must fall, and they must fall across the value chain. And of course, in some ways, it doesn't matter if, and in terms of who is responsible for those emissions. For the oil companies themselves, the emissions of CO2 is an inherent part of the use of fossil fuels. So whoever's responsible in some ways does not matter. That the fact that these emissions must fall creates the need for oil and gas companies to move away from these fuels, to transition away, or run the risk of creating significant stranded assets, destroying shareholder value, and clearly being bad for the climate too. So you see there as being multiple perspectives on emissions targets. There's the environmental perspective, who is responsible for greenhouse gas emissions. There's an alignment perspective. Of course, companies are looking to maintain their social license to operate. And of course, there's the financial risk perspective, which is, Carbon Tracker's sort of main sort of area of research. We're looking here at the investor exposure to transition risks. So again, investors may not care individually about climate change, but they should care from the destruction of shareholder value by companies sanctioning assets that are not needed in the as the world inevitably transitions away. So then when we look at the targets themselves, net zero targets vary significantly, and we see some key shortcomings in those targets and ambitions at the company level. Some of those cover just operational emissions, so just scope 1 and scope 2. But of course, those are only 15% of total emissions. So the 85% emissions associated with using driving your car, ultimately 85% of those emissions from the fossil fuel usage comes from the exhaust pipe. And the companies with scope 1 and 2 targets just totally ignore those emissions, but they're exposed to them through that full value chain. Other target shortcomings, some companies use an energy intensity approach, where they look at the total joules of energy divided by the tons of CO2. So of course, if you add renewables to your portfolio, your average emissions intensity goes down, even if the absolute level of emissions remains the same. So, and in some cases, companies could even grow their fossil fuel production and their supply of fossil fuel products from the downstream businesses, and make progress on that metric without any reduction in emissions at all, or any benefit to the climate. So we see those as being the two key shortcomings in current targets. So we think it's critical for corporate climate goals to be framed appropriately, for them to link to finite climate limits. And so Carbon Tracker, we've defined 3 hallmarks of Paris compliance, and we first defined these in November 2019, and they're still just as relevant today. And for our view, for climate targets to link through to finite climate limits, corporate targets should include the full life cycle emissions, so scopes 1, 2, and 3, where scope 3 is predominantly the end-use emissions. Have finite limits, so with interim milestones on an absolute basis. So this is not about getting to 0 in 2050, it's about what are your reductions in 2030 versus today. So that's crucial for framing the shape of that pathway to net zero. And then finally, we see that corporate targets should cover emissions from the equity share of production and global product sales. So this is about not saying, oh, well, we don't operate this field, so we can't, it's not under our control. Our view is if you have an equity investment in a field or in any asset, or in any asset which is predicated on creating emissions, that those should be included within corporate targets. These hallmarks are prerequisites for alignment. Just because you meet these 3 hallmarks does not mean that your company goal is Paris compliant. There are other factors to consider. For example, your project sanctioning processes, the impairment prices you use, some of your accounting practices, and of course, executive remuneration, all of which we've written about elsewhere. And it's also, I should add, that a target framed along these ways, such ways, is valid for different company strategies, whether it's a wind down strategy, a transition strategy, or others too. The key thing is moving away from fossil fuels and reducing your corporate exposure to fossil fuels, and in turn reducing your investors reducing your exposure to fossil fuels as their usage must fall. So we see that ultimately the rankings, so what we do is we take those hallmarks and we use them to produce a relative ranking of company goals. And so our universe consists of 10 of the largest listed oil and gas companies, It's a slight, with one addition from last year, which is Occidental in the US. What we do is we apply those hallmarks, and we use the characteristics of those the metrics that each company has to define the tier, so which are the coloured bands on that table on the right. First, looking at, do company goals include end-use emissions? And then secondly, do they use an absolute or an intensity approach to emissions reductions? So that defines the coloured band where those companies sit within the table. And then within each band, we look at the coverage and the scale to rank companies in that tier. And we place significant importance on the absolute emissions reductions to 2030. Now, I should reiterate that the ranking we see on the right is a relative ranking. So it's not to say those at the top are Paris aligned necessarily at all. It's just very much a relative ranking to look at the different company approaches and how they link through to finite climate limits. So in the top band, we see Eni, Total and BP. Total and BP we see as having shortcomings in that Total's targets only cover their European sales, whereas BP's targets, or ambitions I should say, exclude their investments in Rosneft and of course only look at their upstream activities. However, all three of those companies have an absolute basis to emissions reductions. In that middle tier, in the yellow, we have Shell, Equinor, Repsol, and Occidental, all of whom include Scope 3, so end-use emissions, but none of which have an absolute approach to target. So all four use intensity approach. And I should add here, of course, there was the Shell ruling recently. So this report was released on the same day, actually, as the Shell ruling. And of course, if that ruling is upheld and Shell does then change its emissions targets, it may move into that upper tier. But clearly, we need to wait to see how that pans out. And then that lowest tier, you have ConocoPhillips, Chevron, and Exxon, who neither cover end-use emissions and all have an intensity approach to target reduction. I should point out, so ConocoPhillips have a net zero target, but we see that net zero target is very, very different to Eni's net zero targets, for example. We should also add that all these companies invoke carbon capture, utilization, and or storage and negative emissions technologies within their target setting. And of course, these are unproven at scale. So we see a clear three-tier approach, and we see also the rankings reflect the company view on the pace of transition. And we see that we think it's important that investors also look at these emissions targets as effectively a proxy for the company view on the pace of transition. So those with the most ambitious and the faster pace of emissions reductions that link through to finite goals, finite planetary limits through the hallmarks. Those companies are also are seeing the faster pace of transition, and that's reflected in some of the other corporate decision making too. Now, not a key focus of this report, but something I think is important to bring out, and there's clearly much more detail of this in the report, is that emissions mitigations may not be all they appear. And crucially, the term CCUS covers a spectrum of technologies. It covers carbon capture and storage, so the permanent storage, so that could be a way of reducing emissions, but it also covers carbon capture and utilization, so effectively capturing carbon dioxide as a precursor into plastics, for example. And there's carbon capture, utilization, and storage, so enhanced oil recovery. So the term covers a broad spectrum of activities, some of which have very limited climate benefit. And of course, there's negative emissions technologies, which are used for carbon dioxide removal, generally used to offset emissions produced elsewhere. So an example of this might be afforestation, so planting of trees. But again, offsets may not all be all they seem, and transparency and credibility are absolutely crucial to ensuring that if companies are deploying offsets, that they've identified the land, and that, if they're third-party offsets, that actually the tons of CO2 are coming out of the air and are being stored permanently, they're expecting. Now, so there's a Venn diagram on the right, and I encourage everybody to read the report to look at that in more detail, but it's worth just highlighting that things BECCS, so bioenergy, carbon capture and storage, could be used as both a carbon capture and utilization storage technology, but also as a negative emissions technology. Now, the point really here is not to go into the detail, but to highlight that the interaction of these terms is quite complex, and that they're often used interchangeably and quite loosely. So it's really important to actually understand if a company's saying it's doing CCUS, what type of CCS is that actually, and what is then for the climate benefit, and crucially, what also is the benefit of de-risking that company's activities from an investment perspective. And so that is a very high level. I'll leave you with the same key points I started with, but that's a very high level view of our most recent report. We really hope that creates the link between the climate science and the financial implications, particularly around the transition risk element. So I'll now pass back to Andrew.
Thank you very much, Mike. Much appreciated. We'll shortly go on to our panelists, but just to reiterate, seeing as we've had people sort of join continuously over the last 15-20 minutes, I can see we've got a good number of questions coming through, but if you have any questions for Mike or indeed any of the other panelists or general inquiries, do stick them in the Q&A box at the moment, at the bottom of the screen. Right, now let me introduce Greg Muttitt. Greg is a Senior Policy Advisor on Energy Supply at the International Institute for Sustainable Development, and he'll be our first panelist to make some opening remarks. Take it away, Greg.
Thank you, Andrew, and thank you, Mike, for a very clear presentation and also a really important report. And three things in the report that I think are especially important in the hallmarks there. One is the focus on scope 3. Secondly, the importance of absolute versus intensity targets, and thirdly, the importance of near-term action this decade before 2030. What I'm going to do is try and zoom out a little, give a bit of context as to why I think this is important and why oil companies haven't got there yet and why they need to. The way I see things, there are kind of two different phases in the history of climate mitigation policy. If we think back to the 90s, when it was a new issue, we were trying to find ways to bend the curve. We were looking for incremental improvements in emissions compared to a business as usual baseline. So that was how we started out in climate change. But that's not where we are today. I think at least the last 10 years, perhaps emerging post Copenhagen, or from the wreckage of Copenhagen, we're now in a stage not of incremental improvement, but of transformation of energy systems. And what's driven that phase, that approach over the last 10 or so years? I think obviously the Paris Agreement, the hardening science that finding that even 2 degrees is a dangerous level of warming. We need to aim for pursue efforts to limit warming to 1.5 degrees, but also the science of carbon budgets, which Mike talked about a little bit. So carbon budgets were really strongly established in the IPCC's 5th assessment report in 2013, 2014. And they tell us two things. One, they tell us, firstly, that we have to reach net zero emissions to stabilize temperatures at any level. And secondly, how we get there really counts, as Mike says. And that's because every ton of carbon counts. A ton of carbon will stay in the atmosphere for centuries, and so the cumulative impact is important. And this really highlights the urgency of the situation we're in. I mean, Mike talked about the carbon budget for 1.75 degrees. If we look at the carbon budget for 1.5 degrees, that's just 11 years of present global emissions. If we don't start to bend the curve now, that carbon budget will be gone in 11 years. Now, why I think companies are having a problem with this phase of climate change is to a large extent, the oil companies are still thinking in a 1990s incremental improvement kind of a way. And so certainly those companies in the bottom tier, especially US companies, they're thinking about incremental improvements. How can we reduce our operational emissions a bit? I think that the same is true also of the middle tier, who are thinking about scope 3, but focused on intensity rather than absolute emissions. Now, only the top tier have started to, I think, internalize the meaning of where we are now with climate change, the urgency, the need for a transformation of our energy systems. But even they, I would say, are not there yet. If we look at how fast the change needs to be, the average IPCC scenario aiming for 1.5 degrees of warming sees reductions in global oil production this decade of 35%. And the scenarios that don't rely on unproven technology, such as CCS and negative emissions, it's 45%. So what this says is that, for instance, Eni at the top of the table, even though they've structurally got a lot of things right, or most things right in relation to the hallmarks, they're talking about a 25% reduction. That may not be fast enough. The kind of pace that the court case ordered from Shell, 45%, or BP's target to 40%, with, as you say, the problem that it really needs to include Rosneft and hasn't yet, that's a much more appropriate pace. And that's really where, that's the context in which last month the IEA said we don't need any new oil fields or gas fields to be developed beyond those that are already in production or under development post-FID. And that's because, you didn't show this scenario on your second or third slide, Mike, but when you look at a 1.5 degree scenario, the pace of reduction in global oil and gas that it implies is equivalent to the natural decline of production from existing oil fields. There is no need for any new stuff. And that suggests potentially for absolute impact 2022, maybe you have a fourth tier. And no companies are there yet. None have said that they won't develop new fields, but that's where we need to be thinking in terms of alignment. And bear in mind that all of these things, the IEA scenario, the 35% reduction in the average IPCC scenario, these are including CCS, these are including negative emissions technologies. So there's no get out of jail free card here. CCS and carbon dioxide removal may play a limited role, but they don't get you away from the need for rapid reductions. The final thing, I want to conclude by saying something about risk. So a couple of other things characterize this current phase of climate policy. The first is that we're no longer talking about blueprints or treaties that will shape the next decades. Climate policy is bottom up. Under the Paris Agreement, it's ratcheted. Ambition increases over time. Secondly, we've seen increasing focus over the last decade on transition risk. And thirdly, we've seen dramatic cost reductions in alternatives to fossil fuels, particularly wind and solar and batteries. Now, what all of this conspires to increase the risk for companies that don't take into account the need to align with the Paris goals along the lines of the hallmarks that Mike describes. If companies continue to delay their alignment, not only will they have to change later on, but they will have to change that much faster. Because let's say a company aligns in 5 years' time, there will have been cumulative emissions over the next 5 years that require that much faster a reduction subsequently. So to conclude, the longer that companies delay alignment, the faster the change is going to have to be, and the more capital will be at risk. Thanks ever so much.
Thank you very much, Greg. Now we'll move swiftly on to our last panelist. That's Natasha Landell-Mills, who's head of stewardship at the investment manager Sarasin and Partners. Over to you, Natasha.
Great, thank you, and thank you both to Greg and Mike. Great presentations, and I think I probably don't need to repeat the kind of really core and important conclusions of the report, namely that if we don't act now, it's going to be too late. The concept of carbon budgets is really, really important. Indeed, the longer we leave it, the nearer that net zero target date is going to have to be. And we're already struggling with the idea of getting to net zero by 2050. To bring it forward is going to be extremely difficult. So what I wanted to do in my 5 minute or so allocation is just give you a shareholder perspective on this, and in particular drill down a little bit into the kind of really key issue here, which is credibility. So what we're talking about is the oil and gas majors actually having moved some way now in terms of setting targets, accepting the fact that we need to get to net zero. But I think there are huge question marks around the credibility of those targets, and indeed the interim targets themselves, which we've heard are not necessarily robust enough. So, I think if we're looking at credibility, the most important thing that needs to happen is that capital needs to be reallocated. Now, for that then to happen, we need to have an incentive structure that ensures that it's in management's interest to reallocate that capital. And for that, I would really underline the importance of having accounts financial statements that are aligned with the very targets that those companies have set. So in simple terms, if your numbers are not aligned with getting you to net zero by 2050, then your capital allocation will not be aligned with getting you to net zero by 2050. And if we want to move the needle now, then those numbers need to change today. So that is something you may have heard me talking about before. It's something that more and more investors are calling for, which we refer to as Paris-aligned accounting and also Paris-aligned audit. But when we do look at where the oil and gas majors are on this, we have seen some positive progress, particularly at Shell, BP, and Total. But none of these oil and gas companies have financial statements which in any way are pricing in a net zero by 2050 scenario. So if I take the IEA scenario, and there are a number of critical assumptions embedded within those financial statements that I would draw your attention to. So, as long as these entities continue to assume that the oil price will be even 50, which BP now assumes, 50, 60, or $70 a barrel, we're not going to see that capital being reallocated fast enough. Because in other words, what that underpins is a profitable outlook for reinvestment. Likewise, let's move beyond the oil price. What about refining margins? What assumptions are there? Certainly, apart from Shell, which has just recently brought down those refining margin assumptions because of decarbonization, and that saw roughly a 6 billion impairment, none of the others, as far as I'm aware, have done that. So if they continue to assume refining margins in a kind of business as usual sense, you will continue to see reinvestment capital allocation into those activities. Carbon taxes that they're assuming are far too low, not aligned with net zero. Asset life assumptions, are those aligned with phasing out by 2050, which would for many assets be far sooner than that? Are the liabilities, the asset retirement obligations associated with those assets being properly reflected in the accounts? And again, if they were, would that not bring down reinvestment? And then we've heard about things like CCUS, CCU, CCS, negative emissions technologies, all of these things that are being put out there as part of the company strategies to get to net zero. Are they costed? As far as we can tell, no, they don't appear anywhere in the financial statements. And again, how does that affect their incentives? I think overall what we're talking about here is potentially, and Carbon Tracker really provided the lexicon here, which is carbon bubbles. We're talking about carbon bubbles. We're talking about the expansion potentially of risks related to stranded assets if we continue to get reinvestment into activities that ultimately we do not need to see. Clearly that should be of interest to investors and shareholders, but it should also be of interest to employees, suppliers, taxpayers in general. An aspect of this that I don't think has seen enough attention is the dividend aspect. Many shareholders are very reliant on dividends from these oil and gas companies, but are those dividends today continuing to be justifiable given the outlook of potential write-downs? Are companies over-distributing, and therefore should investors be alerted to this fact sooner rather than later? So I guess if I was just kind of to draw this together as to what investors want and actually need to see, we need to see greater visibility of risks to our capital and risks to dividends. We need also to see a change in the way capital is being allocated, because of course, as I say, continued allocation to activities that then become stranded is not helpful for investors, and it's not helpful to society, and it's certainly not helpful to the planet. And we need to then see what that capital, or where that capital is now going to be reallocated to. Is it going to be passed back to investors instead of being reinvested into these activities, or is it going to go into renewables? And if so, what is the investment case for that? Do we need to see maybe these oil and gas companies, just throw this out there, being split into kind of good energy and bad energy, and the bad energy bits of this business being wound down? I might end with just a couple of points then. I mean, I've highlighted why it is so important that the underlying numbers that are driving capital allocation decisions are effectively corrected to take account of climate risks and the net zero pathway. But investors are not just sort of passive bystanders in all of this. You know, we have a vote, and indeed we have a responsibility to use that vote. We should be appointing boards that will lead us through this, as I think Greg said, this transformation, no longer this incremental change, this transformation. We appoint the boards, we need to appoint the right boards. And indeed, we also need to appoint the right auditors who will make sure that the numbers that are coming out are actually aligned with that objective. Thank you.
Okay, well, thank you very much to Natasha and all the rest of our presenters and panelists. Maybe I'll just continue briefly on that theme of external pressures before we move on to the audience Q&A. Now, you know, we've had a lot of news on this recently, but I suppose one of the bigger events that's happened recently has been the engine number one proxy battle with ExxonMobil. I mean, Exxon haven't exactly been seen as a leading light on climate, and that's eventually sort of bubbled up into a campaign which ultimately ended up them losing a vote on a number of different directors being voted onto their board. And I think, you know, that's probably the clearest example, but I think it's probably fair to say that a lot of the company activity on climate has been driven by external stakeholder pressures. So, I mean, on that note, Natasha, what's next? What's next in terms of stakeholder activism? So I'll start off with Natasha, but you know, let's take a wider view on stakeholders, and Greg and Mike do feel free to join in afterwards.
Yeah, look, I mean, I think what happened at Exxon is a watershed. I think it's really, really important. I think just to give you a sense of, you know, the significance of this, you know, on the very same ballot, you also had a vote that's reappeared over and over and over, which is splitting the chair and the CEO. This is plain vanilla, very sensible governance, you know, and that only got 40% or so support, and yet an activist that was completely invisible about 12 months ago has come onto the scene and effectively orchestrated a boardroom coup and was successful. So in other words, you've got really credible and large institutional investors who are now prepared to vote on climate in a way that they're still not even voting on plain vanilla corporate governance issues. So this is really important. This is sort of the zeitgeist, if you like. I think people are really understanding now the urgency of the issue and the fact that we need to start voting accordingly. So what next? I think we need to start seeing that happen across the piece. I think that shareholders need to start saying, yes, climate is actually an issue on which I'm going to base my vote regarding reappointment, whether it's the chair, whether it's, you know, any other director. I would point to the audit committee chair in particular when we're concerned about the failure to report properly on the risks and make sure our accounts are Paris aligned. We need to see that happening across the board. What next? Also, in terms of supporting that, we need to see the proxy agencies themselves stepping up and saying, actually, we're going to align our voting recommendations with a net zero world. They should be making their own Paris commitments, just like the oil and gas companies are, just like asset managers are, and making sure that the market is properly informed so that they can vote accordingly. I could go on. There's lots of other things that need to happen, but I'll pause there.
Mike and Greg, anything to add from your side on the wider stakeholder view?
Just very briefly, I think on this agenda, the oil and gas companies are really lagging behind the curve. And even on those that are at the front of the pack, the BP, Total, Eni, they've to a large extent got there because of investor pressure in Europe. Investors have played a crucial role in this and continue to do so. The other type of stakeholder that I briefly highlight is governments. Governments are getting more serious about this, tackling production of fossil fuels. So we're seeing jurisdictions ending the licensing of new oil and gas fields in their territory. So Denmark and Ireland, Spain, state of California, Costa Rica, etc. This is going to be a growing trend, and not only ending new licensing, but setting end dates for production in their territory. And if investors want to minimize their risk in companies, they should really keep pressuring the companies to catch up with and get ahead of this curve, not lag behind it.
Thanks very much. And maybe, Greg, while I've got you, I might add another question on. So we've had a lot of questions coming through with a similar theme. Well, a number of different themes, but one of those that's prominent certainly is, the research clearly focuses on the listed majors. Now, focus on those because they're the ones that have kind of set the most interesting targets by and large, but they account for a minority of production, including national oil companies, do account for the lion's share of that. So I'd be interested to hear your perspectives on how national oil companies might fit into this, and how they can help contribute to kind of the energy transition that's going on, or are they lost causes?
I mean, I'm glad people have raised this. So national oil companies account for, I think, just over half of global production of oil. And the important thing here is that they face precisely the same issues as the international oil companies do. So for international oil companies, there's a risk to shareholders from the transition. For the national oil companies, there's a risk to government budgets from the transition. Now, if anything, I would say most NOCs are actually behind the international oil companies, the IOCs, in thinking about this. They're even slower at internalizing the need for transformation, and in some respects they have bigger challenges. In some respects they have advantages as well, because they can be driven by government mandate. But so I'm involved in a process at the moment of talking to national oil companies about this question. I know Carbon Tracker had a report a few months ago called Beyond Petrostates, also flagging the risk issue for producing governments. So this conversation, as I say, it's a little bit behind with NOCs where it is with IOCs, but it is happening, and it's at least as important, possibly even more so.
Thanks, Greg.
I think, thanks, Greg, and thanks for flagging the Beyond Petrostates report. I mean, I think, as you say, the equivalent investors in the NOCs are the citizens of those oil and gas producing countries, the petrostates. And I think what's really important also to flag is that the physical effects of climate change are going to disproportionately impact those petrostates, many of which are developing nations and many of which are in the global south. So it is absolutely within those nations' interests, long-term interests, to act on climate change. So it's within their interests, and through groups such as OPEC Plus and others, to act together to reduce the reliance on fossil fuels. And I think I'd also draw two distinctions here. One is around their domestic energy supply in some of these oil and gas heavy nations, but the point here really is around the oil and gas exporters. So where significant proportions of their fiscal budgets are from oil and gas export revenue. Now, that's either through the direct investments in the NOCs, or it's through broader taxation of listed company activities. Either way, those revenue streams to the state are particularly vulnerable. So clearly, as demand falls, of course, oil is in global markets, so demand falling somewhere will cause price falls globally. So as demand falls, price falls, therefore revenues fall significantly for these countries. And we see some countries in that report, their revenue streams from oil and gas, their total government revenues falling by about a half over the coming decades in a Paris-aligned scenario. So the key thing there is that these countries, as Greg said, is absolutely not immune, and there are huge fiscal sustainability challenges, which ultimately will feed through to fiscal budgets and the ability of the state to provide services and such as healthcare for those countries. So it's critical that these countries act too on this. And if I may, I'll just make a sort of a follow-up point to the previous question as well, actually, around, the listed companies are slow to act. Societal awareness is absolutely growing, which is clearly driving investor pressure and policy action. I think the key thing to recognise with investments in oil and gas here is around the stranded assets piece, is that investments in oil and gas have long payback periods, and are, if you sanction the oil and gas project, be that a refinery, be that a production platform, it takes a long time. Or a pipeline, sorry, these projects are predicated on 30, 40 years of future cash flows. So decisions taken now affect your financial position for decades to come. And so it's that time lag. And as Natasha says, this pace of change is accelerating. And if you're investing in assets that are going to be around for a long period of time, that really creates and exacerbates the risks involved.
Yeah, indeed, Mike. And I mean, on that topic, I mean, you're someone who's joined Carbon Tracker, having previously spent a decade working at an oil and gas major. We've heard about a lot of things that need to change, and unsurprisingly, given that we're talking about the kind of the entire strategy for oil and gas companies that's been around for a long time now. Would you be interested to hear your perspective on what needs to change internally at some of these companies in order to enable such changes? And one of the things you mentioned, for example, was remuneration practice. We've had a couple of questions on that. Are there other things as well? Are we talking governance, or does it come down to just a change of personnel?
Great question, actually. Thank you. I mean, maybe if I touch first on the remuneration piece. So as I touched on very briefly, the hallmarks of Paris compliance that we outline here they're prerequisites for a company potentially being considered Paris aligned. So we see that, and those apply to the emissions target. So even for a company who has emissions ambitions or goals that fulfill each of those targets each of those hallmarks, and is not overly reliant on CCUS or negative emissions technologies, even for those companies, we need to see Paris compliant activity in a range of other areas. One of those is accounting, one of those would be the sanctioning decisions, i.e. looking at long-term pricing, relating to scenarios, accounting, sorry, I just said, and then remuneration. So on remuneration, of course, we've written a number of reports, the most recent of which was Groundhog Pay in December 2020. I'll put the link in the Q&A. But the key point here is that companies, despite ostensibly looking to be Paris aligned and positioning themselves as part of the solution, the significant majority of the large listed oil and gas companies still incentivize executives to produce more oil and gas, which is totally at odds with meeting Paris goals and a reduction in emissions. Ultimately, more production equals more emissions. It's an inescapable fact of this. However much you decarbonize the operational emissions, the 85% of end-use combustion emissions remain. So we see it's critical that particularly direct growth incentives such as reserves replacement ratio or production growth metrics are removed from executive remuneration. You do have some companies that have 10% of executive bonuses are linked to progress on energy transition goals, yet the same company may have a 20% portion of the bonus linked to growing reserves replacement or increasing production. So we see that it's critical that remuneration backs up the climate policy, and ultimately you don't have almost a duplicitous remuneration policy, because at the end of the day, individual people act individually, whether that's at the coalface, so to speak, or in the senior leadership. Ultimately, individuals are incentivized to by the incentives that are put in place, and people will respond to those. So we think it's critical those are applied. To answer briefly the second part of the question around other things that need to be done internally, I mean, as a geologist, or as a background as a geologist myself, I think it's important that companies allow if a company is going to adopt a transition strategy, so some of the leading European majors are, if you are going to adopt a transition strategy, allow your workforce to transition too. And ultimately, as part of that just transition, I think this clearly is allowing the individuals to transition through, and it may require retraining, it may require reskilling, but a message of we need to reduce production, yet you still have a production division or a individuals, it's very hard at the individual level there. So I think you need to provide those individual opportunities too.
If I may, Andrew, you're actually on mute.
Yeah, I was just about to ask you about some of the things that you were asking for at Sarasin, but still a year in, I'm still talking while on mute. But over to you.
You know, I was just going to add to Mike's comments about REM, because I think what's also really important to understand that if you actually do get accounts that properly bake in that net zero pathway, then the numbers on which REM is based will be aligned with Paris. So right now, you know, the numbers are, if you like, overstating the returns, I think, that will likely come from fossil fuel reinvestment. And that then, because your REM is based on those numbers, you're arguably getting bonuses based on very ephemeral or mythical profits, because they're not properly accounting for future liabilities, falling prices, all the sorts of things that Mike was talking about. But if you get those numbers to properly account for those, then the REM that is based on those numbers will be calibrated to align with that net zero pathway. In other words, you know, you will see from those numbers that to reinvest in fossil fuels is maybe less profitable than it was, and actually to go into renewables be more profitable, and therefore you'll be incentivized to do that because your REM is linked to ultimately to the earnings that are generated. So it's a really neat solution to one that I think otherwise leads us to complexity, opacity, and also conflicting incentives. Because, you know, if you say, oh, 10% of your LTIP will go to this and 10% will go to that, and then, you know, 30% will go to that, you get a mess. And actually, there is ultimately just focus on delivering earnings. So we need to really get that earnings number right in the first place.
Thanks. Hopefully we've just got time for a couple more questions. I guess, you know, just to hopefully if you could just sort of briefly explain, I suppose, you know, how does one go about setting Paris-aligned accounts? What do you think are the key sort of changes that need to be made, and the sort of key outputs you'd expect to see from that?
Yeah, and I'll be brief because I recognize so much time. But yeah, I think in the end, we want the directors to do that and to tell us, because effectively what we're saying is that the accounts now are based on assumptions we can see have not been calibrated for a net zero scenario, but we don't know actually how the changes in assumptions will feed back through to impairments, write-downs, etc. So we want the boards to deliver those accounts for us, and we want the auditors to check them. But the obvious things that need to be looked at are those long-term commodity prices, the long-term refining margins, the asset lives, the asset retirement obligations, you know, fair value of traded assets on the bear. Pretty much absolutely everything needs to be looked at. So yeah, hopefully that gives you a sense.
Yeah, no small job, I'm sure. I think I just to I suppose to come back in the last few minutes to I suppose to try and link the kind of more strategic aspects of how you achieve those targets with the targets. I mean, one of the themes again that's kind of risen out of the questions is you know, what model, given that oil and gas companies plainly need to change what they're doing, what model should they be picking in future? And I think, you know, broadly speaking, there's been the sort of the transition model, there's a runoff model. The presumption, certainly in Europe, seems to be that companies are going into lower carbon and energy alternatives. Certainly not the only model. It'd be good to hear. I suppose you know, at Sarasin, are you do you favour either of those? Do you have any criteria for choosing? And then also, you know, Greg and Mike as well do chime in.
Yeah, again, we're not really in the business of micromanaging and saying you should be doing this or that. It's really the board's duty, and we appoint the board to make sure that that happens. But clearly, having some visibility of the returns that are expected, and also, of course, how the cost of capital will change. And that's where I mentioned earlier, you know, a bit like a good bank, bad bank model. You know, I could see some arguments for that approach going forward for a number of these businesses, in that you kind of hive off the bit that's riskier, which you kind of wind down, that throws off a lot of cash, and actually that could justify a reasonable, multiple versus the one that's going to be a very different business with a different cost of capital, probably in the utility space, etc. So I think we leave it to the boards to make those decisions, but they need to justify them.
Maybe I could briefly add. I mean, to me, the two strategies that there are kind of postponement or avoidance or denial strategies, but the two that really embrace and internalize transformation. One is to transform into a different business, whether that's other forms of energy or something else, and the other is to progressively wind down, returning money to investors, to shareholders. I've only seen companies propose the first of those. I haven't seen any talk about the second, although some investors do talk about it. And they talk about it in part because they would like to make their own decisions about how much to invest in renewables in their portfolio and how much in oil and gas, rather than have those decisions made for them by oil and gas companies integrating the two. And what's really, I was saying to someone in the chat in the Q&A, what's really interesting about this, and quite important, I think, is that this might be an area where investor interests and company management's interests aren't very well aligned. And so I would expect and hope to see this debate coming more to the fore in the coming years.
Yeah, I mean, thanks, Greg. I mean, I totally agree. I mean, there are apart from the denial, there are those two main strategies: wind down or transition. But I would perhaps add that the transition could be to energy, as you say, or even could be to any other business area. The key thing is moving away from a business that is inherently reliant on fossil fuels and the emissions that result from their usage. And that's the fundamental piece here. And I think that's really important. And again, as you say, alignment between senior management, senior management aims, goals, particularly the personal level and the corporate ones, again, comes back to that remuneration piece, as you say, and that's really important. Ultimately, it's for the wind down. Absolutely. Is it better that investors have their capital back and can go into renewable specialists, or continue to invest in these behemoths that will take many years to transition and develop these new businesses? Who's to say? But potentially investors should have that choice, which I think is really important. And for the wind down strategy, the problem, of course, is the message of, well, we're going to get smaller by 10% every year. My salary is going to reduce by 10% every year as a CEO, and I'll turn the lights out at the end, is not great for a personal level at any level within that organization. However, for it to be effective, investors and governance of these companies need to get that remuneration piece right. So maybe you reward people for the value strategy that maximizes the shareholder returns through that wind down. And as Natasha and both Greg say there, that's, we think, really, really important. It's ultimately moving away from fossil fuels for investor interests and for the climate too.
All right, yeah, weighty strategic challenges to be tackled. We're about on the hour. Unfortunately, we're probably never going to cover everything. Thanks very much for the huge amount of engagement Q&A that's come through. We'd love to tackle more, and I'm sure we will on future webinars, because certainly this is a topic that's going to rumble on, and I think it's fair to say that no one's absolutely nailed it yet. But yeah, on that note, thank you very much to Mike, Greg and Natasha for a great discussion. It's been fantastic to hear your perspectives. Thanks everyone that's joined us and submitted questions. We hope you've all found it valuable and useful, and yeah, all enjoy the rest of your day. So it's farewell from us. Thank you very much.
Thank you.